Okay, so what is a director's loan account? I've covered this off before in one of my previous videos, but I'll give you a refresher. So any director who takes money from a company, it actually technically goes into a loan account, which at the end of the year is reconciled by the accountant or whoever's doing the books. Now, if they run a payroll, usually they're on a small salary, which is maybe up to $12,500 a year, which is your tax-free allowance. So you'd have to run the payroll monthly to get this through the payroll, but it makes sense to do that because it's tax-free. Any other money is taken goes into this loan account, and at the end of the year, the profit is calculated minus the corporation tax, and then that amount left is your net profit, which essentially you can take as dividend. And most directors do it like this and then pay the tax on those dividends as per the national rates. Now, if, for instance, you've taken too much money for the profits after the tax has been paid, then essentially you create an overdrawn director's loan, which means you've taken too much money for the profits that was made in that year, which is fine because it can be added and transitioned over to the year after and taken out of future profits. But fundamentally, if you end up closing the company in that time, there'll be an overdrawn director's loan account, which essentially means that it's an asset of the company, it needs to be paid back. And any liquidator will fortunately write to you to repay this in full. So it's a very, very complex world if you are salaried and dividend, and it's incredibly important you get it right before you even consider the insolvency process, let alone engaging an insolvency practitioner. We're on your side, we're in your corner, the Directors Helpline.